Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. Macro data is back. Been about a week and a half. We've been waiting. There's been very little that's hit the tape here. And the markets have been trying to figure out what all is going on and looking for a path of least resistance through it. Well, now data is back. We are going to be looking at the first quarter U.S. GDP number that's going to be coming across the wires here in the next 24 hours. And so we are going to have a look at what all of this means and focus really on less so whether the number might be better, worse, or indifferent relative to expectations, and really hone in on what the reaction function is likely to be. What are markets likely to actually do with this data, depending on what the outcome is, and how might the different asset classes respond, and find a configuration there that's a bit different than what we are perhaps used to over the past several weeks and months. So let's consider first what the expectations are and do a bit of stage setting. Needless to say, June of 2020 and the subsequent few months look crazy on this chart. That's the COVID lockdowns and the subsequent reopening. So you get 30% annualized decline and then a 35% annualized increase. But as you can see, thereafter, things kind of settle. And we continue to go into this more moderate kind of thing where growth is becoming more normal, becoming more like what was prevailing ahead of COVID. As you can see there, we're kind of idling around the 2-ish percentage mark. And this is what we're looking at returning to here in the first quarter. So a decline in the annualized quarter-on-quarter growth rate from 2.6% in the fourth quarter to 2% in the first, seemingly not the craziest of declines, but nevertheless a deceleration. With that, we consider how likely is that in fact? Well, looking at some of the leading indicators here, this is the service and manufacturing ISMs, manufacturing first. You can see here this remains in contraction territory here through the first quarter. So certainly a headwind to growth there. Focus, if you will, on the yellow bars. You can see they're trending down. So the 3 bars finishing the series here, you can see continuing to inch lower. So showing that manufacturing isn't just shrinking. Recall that this works the same way that the PMI surveys work, where 50 is the center line, where there is neither contraction nor expansion. Above 50 is expansion, below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. And so what you're seeing here is that manufacturing is at this point shrinking at the fastest rate that we've seen since basically the COVID recession. So we are in a situation where that has gotten worse through the first quarter. We then look at what's going on with services. This is by far the largest part of the U.S. economy. And you can see here a similar story. The makeup of the situation is a little bit more mixed. So down on new orders, down on the pricing side of things. Seems like employment has just started to roll over the past month or so. But what you have is, in the yellow bars, a clear deceleration, a clear move lower, not quite the weakest since the COVID recession growth here in the very last monthly bar here, the weakest it's been in 4 months and 3 months. But the story of the first quarter, clearly, that we have broadly weaker things happening here. The trend down in growth indications continues. The markets have noticed. So we are looking at a yield curve that continues to drift to a more flat setting. So you can see the small dots there. That's the yield curve before the SVB collapse. You can see that was calling for a peak rate north of 5.25, close to about 5.5%, and was looking as of March of next year with a rate still north of 5. Needless to say, the situation has significantly altered at this point. We are now looking at rates at 5%, basically over the next month to the next 3 months. So in other words, the Fed expected to deliver one more hike next week. That's expected to be the last one. We're expected to hold at this level through perhaps something like in August, September, and then going into the end of the year, significant cuts. So looking at about 6 months from now, so essentially November, December, we're already looking at the first round of cuts. And of course, come a year from now, we're already in the sort of 3 3/4 to 4 range. So obviously the curve here you can see has significantly flattened. And perhaps the main takeaway for me here is that it hasn't just flattened since SVB. That's to be expected. It's flattened over the past week. So as we've had a situation where economic data has been few and far between, the markets, in finding what the new normal is, in finding what is the path of least resistance, have chosen a flatter setting for the curve. And that's very important, because what it says is the natural inclination for markets at this point is to be worried about growth, to be worried about recession. It's certainly not helpful that we've since had this consternation recur with the issues that have been bubbling here in recent days with First Republic Bank, FRB, another one of the sort of tech-facing types of lenders in the vein of SVB and Signature. But the market's seemingly looking at that as opposed to PacWest, another similarly oriented lender, and saying, well, PacWest seems okay. FRB might be an isolated issue. So the concern here is less about we might have a banking crisis that spirals into an '08 kind of a scenario, and more like we might have some episodic failures as the troubled institutions reveal themselves. That might be a slow burn, but what it might do is create a situation where other lenders say, you know what, we're not going to go and try to sell assets. We're going to retrench on lending. Selling assets is clearly, in the case of SVB, in the case of FRB, is being looked at as a sign of weakness and as an invitation for a bank run, an invitation for investors to bet on failure, an invitation for authorities to come sniffing around about receivership and takeovers and asset sales to larger institutions. A bank that wants to survive then probably doesn't go the round of asset sales, which have been significantly loss-making because of the shift in Fed rates. Instead, let's go to retrenchment on lending. Rather than saying we're going to sell assets and raise cash that way, just don't give away the cash. Keep the cash. Keep the cushion. Cut off lending. That, of course, is very bad news for the economy. That's a story about recession and a slow-moving squeeze, rather than a story about a big, fantastical collapse of the banking system, which again brings us more so in line with the savings and loan crisis of the 1980s that Paul Volcker had to deal with as he was in the midst of a significant tightening cycle, then chair of the Fed. Then what Ben Bernanke had to deal with in 08, 07 with that crisis. So with that in mind, let's consider what the dynamics of a weakening situation here might look like in asset levels. How might the price of tradable assets actually respond? Well, there's been some evolution here that's very important, I think, to keep in mind. So first, let's consider the story of the S&P 500 and Fed rate hike odds. And let's go to about the middle of last year as our touch point, because that's the last time that the markets thought they'd figured the Fed out. You can see that from the middle of last year, from about the summer, Fed rate hike odds start climbing. That's the blue line and the red line there. I've essentially chosen June and December, both because they're sort of logical touch points, middle of the year, this year, end of the year. So we're essentially saying, here's the outlook for the first half, here's the outlook for the second half of this year. And of course, also because by current reckoning, rates are expected to peak in June. That essentially that will be the end of this, that May will be the last hike, June will be the first hold. So what we're looking at then is from July through about end October, there is a build in rate hike expectations that then leads the S&P lower. The S&P is represented here by the yellow bars on the bottom, and I've put a little 5-day moving average on there just to get a sense of what the trend is so that it's easier to follow. That's that dotted line there. So what you're seeing is as rate hike expectations rise, the S&P turns and starts declining. It anticipates that they're going to start to flatline and bottoms somewhere in between September and October. And of course, we know that bottom is mid-October, and then starts to climb. As rate expectations hold steady, risk recovers because concerns about the Fed action at the next meeting, the meeting after that, the meeting after that, all of that near-term speculation is draining out of the market as these expectations flatline and start to get anchored where they are. As you then get into February, notice rate hike expectations start to build again. S&P doesn't like it, it swings lower. It then continues to swing lower as rate hike expectations crash. That's SVB and the adjacent fiasco. The real difference here starts to occur most recently. And I'll try to flag this for you right here. Notice, whereas here, rate hike expectations being flat gives us risk that's rising. Here, rate cut expectations and just a general deterioration in the Fed outlook here speeds a decline that we see in the S&P. So the relationship here changes. Rate hike expectations rise, it falls. There's a crash, they keep falling. The crash starts to normalize and the Fed outlook starts to rebuild, risk rebuilds. And right here, that direct relationship is holding again on the way down. In other words, as you get now on the other side of the banking crisis as an initial sort of episodic risk, what you're looking at currently is a deterioration in Fed rate hike odds coming simultaneously with a downturn in risk, which speaks more so to concerns about recession risk than a blow-up of some sort. Let's consider the same dynamics for the dollar. So same exact story with rates, but now what we're focused on is how the dollar is responding. And what I've done here is actually picked the Bloomberg correlation weighted dollar index so that we can get rid of some of the skew to the euro that you get in DXY, so you can get rid of some of the cross-currency correlations and really get a clear directional read. So what we're looking at then is a situation now where as rate hikes start to build, as those expectations rise, the dollar gains. As they flatline, the dollar starts to pull back. This is the same as when they flatline, risk starts improving, as we saw before. Notice, as they build, the dollar builds. Again, the inverse of what we saw here. As they build here, risk declines. Then right here, as concentration starts to come off, here, the dollar is actually weakening. This is the dollar's haven relationship. So even as rate hikes are going up, even as expectations for rates are increasing, which is the more accurate way of saying that, the dollar is weakening. But here, things are changing. And I wanted to zoom in on that here so that we can get a real clear read. Here's a zooming in of the relationship between just where rates are going to end at the end of this year, according to Fed Funds Futures. So I've kept the red line here. That's December of 2023. I have the S&P here in the yellow bars, and again, a 5-day moving average just to keep things easier to follow. So let's consider the outlook for where the Fed funds rate is going to be at the end of the year here. Rising. Risk doesn't like it. Collapsing with SVB in them. Risk still doesn't like it. As this starts to rebuild, the rates outlook rebuilds, and then just here, as the markets have been finding their path of least resistance in the absence of data, we are seeing both risk and the rates outlook turn lower. This is pointedly different than the market saying, oh, fewer hikes is good news. That's less of a hurdle on investment. This is a worry about recession, which means that if we get an outcome that's worse than expected on this GDP number, because of all the various signs of weakness that we've just looked at, we should see both Fed rate expectations deteriorating and stocks follow. Whereas for the dollar, the flip is in the other direction. Notice here, rate hike expectations building, so the rates outlook is tilted upward and the dollar is following. As you get this collapse, notice the dollar actually doesn't fall right away. It actually holds up. through most of this collapse as a haven asset, even though the thrust of the issues are U.S. based. Notice this is not causing the dollar to weaken. Where the dollar really starts to weaken is when this situation starts getting better. So risk sentiment improves, the Fed rate outlook rebuilds, haven demand is coming out of the dollar and it declines. But look here and notice the relationship has changed. Now, with the rates outlook declining, the dollar is getting stronger. This is the dollar finding its appeal as a haven again. And not in the midst of a crisis, but in the midst of building concerns about recession. And this, of course, is exactly the framework that we've been harping on for so long here on Macro Money. This is the dollar smile framework developed by Stephen Jen, formerly of Morgan Stanley, as memory serves, and now over at Horizon, which is a fund and advisory. He developed this framework that argues the dollar is stronger, tends to be stronger, when the U.S. outperforms relative to other major economies, because there's, of course, the story as we saw it last year. If there is a stronger economy, then there's higher inflation. If there's higher inflation, the Fed is raising rates. That increases the yield appeal of dollars because, as we've said many times here, one person's borrowing cost is another person's lending income. So when interest rates that a central bank bids up to fight inflation increase the cost of borrowing in a given currency, they also increase the profit margin on lending in that currency. And so there's a natural move into that currency. There is an appeal to owning it because it can be lucratively lent. And so there's a yield differential to be extracted between a currency that is more attractive to lend and others that perhaps are not catching up. And so you might borrow in a currency with interest rates that aren't rising. The yen is a classic example. Interest rates haven't gone up there in ages. And then lending in a currency that has higher rates and thereby paying little to borrow, earning more to lend, and extracting an income stream. That's called the carry trade strategy. In this environment, then, when the U.S. outperforms, inflation is higher, rates are going up, the dollar has appeal as almost a stock with rising dividend yield. There's a greater income to be had because of these yield differentials. And so, not surprisingly, the dollar was the best performing currency last year. There was the most amount of rate hikes from the Fed. But then there's the flip side. And that's where you have the U.S. economy severely underperforming against the global average. But of course, when the world's largest economy underperforms, what does that tell you about overall risk sentiment and the overall fortunes of the global economy? Well, they don't look very good if the biggest piece is struggling. Based on numbers going back to 2021, that's the latest that we have from the World Bank, you're looking at the U.S. share of global GDP at 24%. That's a quarter of the entire global GDP number. When that is underperforming the rest, you're looking at a situation where there is demand for safety, because that kind of a downturn speaks to a global downturn, not just one that's in the U.S. That, of course, impacts spending everywhere. which impacts earnings everywhere, which impacts the appeal of cyclical assets like stocks, commodities, and such. Not all commodities, certainly, but growth-oriented commodities, your coppers and crude oils of the world. In that environment, people start to divest from those growth-based assets and going into cash. And what more liquid form of cash is there than the undisputed dominant medium of global exchange, the US dollar? Certainly a lot of conversation about de-dollarization out there, but I've made no secret of thinking it is utter nonsense. Not because reserves aren't being diversified by central banks, but because to really undermine the dollar's position, it has to be supplanted as a transactional medium of exchange, and there's simply no alternative. The latest numbers out of the Bank of International Settlements suggest something on the order of 88% of global monetary transactions are settled in dollars. And that number hasn't moved in decades. So what we're looking at here is a situation where you have a flight out of growth-based assets and into cash, but of course, the cash you want is the kind that's going to move the least with a large inflow of capital in and out. That way you don't have to be first in and first out. The alternative would be to pay a lot for an asset that's been driven up by others exiting and buying into whatever currency, and then selling cheap because the outflows, once whatever crisis is over and reinvestment has begun into risky assets, if you're not first, then you're following a flood of money coming out. So if you're following a flood of money going in, you're buying expensive, and then if you're exiting following a flood of money coming out, you're selling cheap, which means you are getting deep losses handed over on your capital. That's not much of a haven then, is it? So what we're looking at is liquidity as the ultimate attraction in a haven, such that it can absorb lots of money coming in, lots of money coming out. And of course, nothing is more liquid than the dollar. So if a recession in the US makes for a recession globally and everybody is divesting, it's the dollar that they're oftentimes divesting into. And of course, this finds us at a very interesting spot for the dollar, just as we come back through all of these swings that we've just watched in detail in recent months, landing the dollar. This is the Invesco Deutsche Bank bullish US dollar ETF, which broadly follows the DXY index. It has landed us at what was resistance at the top of a range holding since 2009 and capping the move higher since then, ultimately overcome last year amid the rate hike cycle. We've backed into that level at 27.19 as a long-term range top resistance becomes support, and put in a very emphatic bullish engulfing candlestick there on the monthly chart, suggesting we are basing, and perhaps the next leg of the move higher for the greenback is around the corner. Whether that will be catalyzed by this GDP number, we'll have to see. But the dynamics of what we're looking at seem increasingly such that if the number is weak, or at least worse than expected, or at least is close to expectations but pointing to deceleration, all of which seems to be increasingly the path of least resistance, then we are looking at a positive story for the dollar and a negative story for stocks as the through line. And that is Macro Money for today. Thank you very much for joining me. As ever, I am here Monday through Thursday, just after Overtime, which is a show I do with Chris Vecchio, head of Futures and Forex here at Tasty Live. I'm on with Chris again on Friday for Futures Power Hour, and on with Tom and Tony for First Call on Sundays. Outside of those, I am opining on Twitter at Ilya Spivak, so come check that out. And of course, writing for the written portion, the blog portion of tastylive.com and Luckbox Magazine as well. Thank you very much, everybody. Good luck out there. See you tomorrow. Take care.